Picture this. You wake up at 6 a.m., not because your alarm went off, but because your phone is already screaming at you with pre-market alerts. You haven't brushed your teeth yet, you're still in yesterday's shirt. But somewhere on a monitor, or three, numbers are already moving, and you feel this weird pull like you might be missing something. That's day trading. It's not what the Instagram ads make it look like. It's not some guy in a penthouse sipping espresso while his portfolio doubles. It's more like a very stressful video game you play with real money while sitting in a room that hasn't seen natural light in 3 days. So what actually is day trading? At its core, day trading is buying and selling financial assets, usually stocks, but also options, futures, currencies, or crypto, within the same trading day. You don't hold overnight. You get in, you try to make money on small price movements, and you get out before the market closes. That's the whole game. No long-term vision, no hold for 20 years and retire rich energy. Just fast, tactical moves based on charts, momentum, and whatever the market is feeling that morning. Now here's where it gets interesting. The regular stock market opens at 9:30 a.m. Eastern and closes at 4 p.m. That's your main window, 6.5 hours. But day traders are awake long before that. Pre-market trading starts as early as 4 a.m. in some cases. Most serious traders are at their desks by 7 or 8 a.m. at the latest, scanning news, checking economic data releases, reviewing their watch list, and figuring out which stocks are moving and why. If a company dropped earnings overnight, it's probably going to be volatile at open. Volatile means opportunity or disaster, usually a little of both. What exactly are they watching? Mostly price action and volume. Volume is how many shares of a stock are being traded. If a stock usually trades 200,000 shares a day and suddenly 3 million shares change hands in an hour, something is happening. Maybe news came out. Maybe an analyst upgraded it. Maybe some hedge fund decided today was the day to dump their position and your stop loss is about to get absolutely obliterated. Volume tells you where the energy is. Price action tells you what direction that energy is going. Combine the two and you've got the basic language day traders speak all day. Most day traders use technical analysis to make their decisions. Forget fundamentals. Nobody's reading annual reports at 9:47 a.m. trying to figure out if a company's debt-to-equity ratio looks clean. Technical analysis is purely about charts, support levels, resistance levels, moving averages, VWAP, RSI, Bollinger Bands. These are the tools traders use to predict what a stock might do next, based entirely on what it's done before. It's pattern recognition at high speed. Think of it like reading a map, except the map keeps changing and also occasionally lies to you. Here's a term you'll hear constantly, the opening bell. The first 30 minutes of trading from 9:30 to 10 a.m. are the most chaotic and most lucrative part of the day. Volatility is highest, volume is highest, price swings are the biggest. A lot of day traders make or lose the majority of their daily profit or loss in this window. Some traders only trade this window and then stop entirely. Others sit it out because it's too unpredictable and wait for things to settle before jumping in. There's no universally right answer. It depends on your strategy, your risk tolerance, and honestly how much cortisol your body can handle before noon. So let's say you've identified a stock. It's a mid-cap tech company. It dropped 8% yesterday after a weak guidance report. This morning, the broader market is green and you're seeing buying pressure building in pre-market. You think it's going to bounce. This is called a mean reversion play, the idea that something oversold will snap back toward its average. You set your entry price, you set your stop loss, the price at which you automatically get out if the trade goes against you, and you set your target. You're risking, say, $200 to potentially make $500. That's your risk to reward ratio. Most experienced traders won't take a trade unless the potential reward is at least twice the potential risk. The math has to make sense before you touch it. You enter the trade, now you watch. This is the part movies never show. It's not exciting. It's basically just staring at a flickering number and trying not to do anything stupid. The stock ticks up a little, then pulls back, then ticks up again. Your palms are a little sweaty. You see it approaching your target. Do you take profits early? Do you hold for the full target? Do you trail your stop loss up to lock in gains? These micro decisions happen in real time with real money, and the wrong call can turn a winning trade into a break-even or worse. This is where psychology absolutely wrecks most people. And speaking of psychology, that's honestly the main job of a day trader. Managing emotions, fear, greed, overconfidence, revenge trading. These are the actual enemies. Revenge trading is when you lose a trade, feel frustrated, and immediately jump into another trade to try to make the money back. It's impulsive. It almost always makes things worse. Professional traders talk about this constantly. The technical skills are learnable. The emotional discipline is genuinely hard. You have to be completely fine with being wrong repeatedly throughout the day and not let it affect your next decision. That's a weird mental requirement for a job. Let's talk money, because this is where it gets real. In the US, there's a rule called the Pattern Day Trader Rule, or PDT. If you make 4 or more day trades in a 5-day period in a margin account, you're classified as a pattern day trader. And once you're classified that way, you need to maintain at least $25,000 in your account at all times to keep doing it. Fall below that, you can't day trade until your account is back above the threshold. This rule exists to protect people from blowing themselves up, which tells you something about how many people were blowing themselves up before it existed. Assuming you have the capital, what kind of returns are we actually talking about? The honest answer is not great, on average. Studies consistently show that the vast majority of day traders lose money over time. One study out of Brazil tracked day traders over years and found that more than 97% of people who stuck with it for more than 300 days lost money. That's not a typo. The ones who do profit consistently are usually trading with an edge, some specific strategy or information advantage that gives them better odds than random. Many of them are also using software, algorithms, or direct access platforms that execute trades faster than a human can blink. Execution speed matters enormously. Retail traders, meaning regular people at home, typically use platforms like TD Ameritrade's Thinkorswim, tastytrade, or Interactive Brokers. These are fine. But professional and institutional traders have direct market access, co-located servers sitting physically inside the exchange building, and order routing that shaves milliseconds off execution time. When you're trying to scalp a stock for 20 cents of movement, a 50 millisecond delay can be the difference between getting filled at your price or getting filled worse. The market is not a level playing field. It's really not. Now let's talk about the actual structure of a day trader's day, because it's more regimented than you'd think. After the pre-market prep and the opening bell chaos, most traders hit what's called the midday lull. From roughly 11:30 a.m. to 1 p.m., volume drops, spreads widen, price movement gets choppier and less predictable. A lot of day traders go quiet during this window. They review their morning trades, update their journal. Yes, serious traders keep a trading journal tracking every single trade, the setup, the entry, the exit, what worked, what didn't, and they mentally reset. It's almost like halftime. The afternoon session picks back up around 1:30 or 2 p.m. Volume starts building again as traders position for the close. The last hour, from 3 p.m. to 4 p.m., can get wild again. Institutional traders rebalancing portfolios, momentum plays accelerating, short sellers covering their positions before overnight risk kicks in. This final hour is called the power hour for a reason. The energy comes back. The volume spikes. If you missed your setup in the morning, sometimes a second chance shows up right here. What about the tools they actually use? Most serious day traders run multiple monitors. 2 minimum, 4 is common, 6 isn't unusual. One screen might show a level 2 quote screen, which displays the full order book. All the buy and sell orders lined up at different price levels. Seeing the order book lets you gauge supply and demand in real time. Where are the big sellers sitting? Where are the big buyers? If there's a massive wall of sell orders at $47.50, the stock is probably going to struggle to break through that level without serious momentum behind it. Reading the order book is its own skill entirely. Options are a whole other layer some day traders add to their toolkit. Instead of buying the stock outright, you buy a contract that gives you the right to buy or sell the stock at a specific price before a certain date. Options are leveraged instruments, meaning a small move in the stock can translate to a massive move in the option's value. A stock goes up 3%, and your call option might go up 80%. That sounds incredible. The catch is options can also expire completely worthless, meaning you lose 100% of what you put in. Day traders who trade options are essentially dialing up the voltage on everything. Bigger wins, bigger wipeouts, and a lot more variables to track. Crypto day trading deserves its own mention because the market never closes. Stock traders get nights and weekends off. Crypto traders are technically always on call. Bitcoin can move 10% in 2 hours at 2 a.m. on a Tuesday. Some crypto day traders build automated bots to trade while they sleep, setting rules and parameters and letting the algorithm run. Others just accept that they're going to be checking their phones at all hours like a new parent. The volatility in crypto is extreme compared to stocks, which means the potential gains are bigger and the potential losses are also genuinely alarming. At the end of a trading day, a good day trader isn't just counting their profit and loss. They're going back through every trade and asking why. Why did you enter there? Was it actually a clean setup, or did you rush it because you were bored? Did you follow your rules? Did you move your stop loss and let a losing trade run too long? Most blowups happen not from one catastrophic trade, but from a slow string of small, undisciplined decisions that compound into a bad week. The journal is how you catch those patterns before they catch you. So is it worth it? That depends entirely on what you mean by worth it. As a full-time income replacement for most people, the statistics are brutal. Most retail day traders underperform a simple S&P 500 index fund. The time, stress, capital requirements, and learning curve are enormous. But as a skill set, understanding technical analysis, reading order flow, managing risk, and position sizing, these concepts transfer to swing trading, option strategies, and investing in general. And for the small percentage who genuinely develop an edge and the emotional discipline to execute it consistently, day trading can be an incredibly lucrative career. The market hands out money every single day. The question is just whether you're on the right side of who's collecting it.